Will the U.S. election change our Canadian real estate economy? And there's no such thing as first-time home buyers with RSPs. Yes, all this and more with our good friend and mortgage broker, Mr. Dion Beg, right after this. Here we are, my friends, with our favorite mortgage broker in all of the land, Mr. Dion Beg. How you doing, my man?
Morning, Gary. I'm great, man. How you doing?
Excellent, excellent. So the first thing you said to me, it's Monday morning and deals are up on your side, Dion. Tell me about that a little bit.
Yeah, that's right. I mean, as I've been mentioning in our previous interviews the last couple of weeks, I've noticed momentum building, confidence building, more inquiry. And, this morning I wake up to four deals, people purchasing over the weekend. And what that means is, all this buildup is now leading to actual transaction. So I sense that a lot of the things that we've discussed previously, lower interest rates, the anticipation of these 30-year amortizations, what that's going to mean for spring market, and people who have the ability to move forward now before extra competition enters the market, they're moving forward now. So this is what I'm seeing. And yeah, it's been a busy Monday morning.
Yeah. October was an interesting month as we close it out, and it's November 4th as we're recording this, and the stats for all of October will come out in the next day or two, and we'll dive into them because we're seeing some interesting things of some transactions happening, just as you said. So there's lots that we're going to cover today. A few stories right hot off the presses of some of your clients and how you're guiding them through their transactions and refinances and such, but there's something big happening to the south of the border. We cannot ignore, Dion.
Look, let us hope that the world remains intact as of tomorrow.
That's right. And no matter how the election goes, it's still we move forward regardless, right?
Yeah, and I mean, look, we can't ignore it. It's certainly going to have some kind of impact. To what extent, we don't yet know. But yeah, I mean, the market has been waiting for this event for quite a while, and the Fed has made some changes. A lot of people think that the central banks are tied to politics. Technically, they are not, right? But who knows really what happens behind closed doors.
Yeah, well, there's always a ripple effect of any decision that happens, and one of those things that's out there, and should Mr. Donald Trump ever get in. And hey, it's an election, so we just don't know. He's talked about the tariffs and adding in tariffs or removing tariffs and all this kind of stuff. And people are saying, well, what if he adds tariffs to the Canadian products? What does that mean? And I did a little research here, Dion, and sure, yeah, it's always going to affect Canada. There are some things, for your small distributors or your small manufacturers that are producing car parts and things like that. From my research, at least, and if things don't change, which they might, it shouldn't affect those type of manufacturers too much. Where it does, and always has been, is the soft lumber, and that's always been a huge bone of contention with Canada and the U.S. because that is one of our biggest. What's the word I'm looking for?
Exports. Yeah.
Thank you. That's the word, exports. So we'll see how that kind of falls into play, and of course, if we're if we're shipping and creating less product to go and export into the U.S., well, that means less money in our own economy, right?
That's true. But, actually, on just a side note, you might have noticed in the last week, the Canadian dollar is as low as it's been in, I think, nearly a decade or so. And so the flip side is, from that perspective, Canadian goods as of right now are cheaper for Americans, right? But that changes over time, and that's also tied to interest rates. Again, a conversation we've had earlier. But yes, lots going on. This election will mean some probable changes.
Yeah, for sure. Okay, I love the real life stories, if you will, that you're having with your clients, and some of those are incredibly relevant. And I love that we are able to share them. That we have this platform to share them because if one person's going through a situation or looking at buying a new investment property or having to refinance something, they're not the only ones. So how can we learn from some of your other clients, Dion?
Yeah, 100%. And I mean, in your business and mine, Gary, it's very much pattern recognition. You know, when you talk with a client, you say, okay, where's your circumstances? What are your goals? Okay, I can see how that all works together. And so, yeah, maybe by sharing these types of real life stories and case studies, people can see their situation on this person's situation. And if they need to chat about it directly, feel free to reach out to you or me. But yeah, I think I listed off some. Which ones did you want to start with there?
Well, let's start with, we always have heard how you can leverage your RSPs into home ownership, and there's a few moving parts for that, and it doesn't always, you can't always use it, but there are some avenues where you can use your RSP and be able to, in a sense, borrow from your RSP and over time pay it back. But there, you had an interesting story with that regard.
Yeah, that's right. So the program we're talking about is called a Home Buyers Plan, the HBP, which allows you to draw out up to $60,000 per individual from your RSP and use that as down payment on your first principal residence. Okay. So everybody knows that that would be applicable to a regular first-time buyer, first home. But I had a question come up just this morning from a client who currently is a tenant and has been a tenant for many years, just a personal life circumstance. But he already owns a rental property, which he's also owned for many, many years. And his question was, Dion, am I able to access my RSPs, 60,000, in order to use that as down payment under the home buyers plan? And the interesting answer is yes, even though he does own a property, because he hasn't resided in that property for 4+ years, or if you haven't owned a property for 4+ years, then you're actually able to access your home buyers plan. So just be aware of that because you own other property doesn't mean that you can't use it. You know, you're actually allowed to use it. And you know, Gary, that also relates to a lot of our younger clients who in the last couple of years, they've been living at home with family, but they may have gone out and bought an investment property. And so those guys are actually also in the same boat. They've never lived in a property that they purchased, or they maybe, let's say they lived in it many years ago, but now they've moved out 4+ years ago. They again are allowed to use their RSPs for down payment.
So there you have it. So it's almost a little confusing in the title of it, right? That we always assume it's that first time home buyers plan.
That's what it's called.
Right.
Well, actually, let's clarify. It's called a home buyer's plan. So maybe you and I have added the first time to the front of it, but I think society has added the first time to the front of it as well, right?
Yeah.
So so it is a home buyer's plan. And look, this also relates to people who owned a property 6 years ago, then 5 years ago they sold it, and they haven't owned anything for 5 years. They re-qualify to use their RSPs under the home buyer's plan.
Right. And you're right. I think society or the industry has labeled it that first time home buyers plan because that's what we called it 10, 15 years ago. And it's on us, my friends, to remove that from our vocabulary.
Well, and the same extends into the insured mortgage category, right?
Right.
So many times clients have come to me saying, oh, Dion, I'm buying my third home and I just don't have 20% down. I'm like, well, you don't need it. And like, well, I'm not a first-time buyer anymore. Well, again, you don't need to be a first-time buyer to use a mortgage insurance or CMHC in order to purchase a property with less than 20% down. So keep that in mind as well.
Yeah, excellent. And maybe provide some clarity too. If you're obtaining a home with that has an insured mortgage, CMHC financing or the like, can we still leverage our RSPs for that and the deposit where that deposit comes from?
Yeah, most definitely. So in either of the examples, if it's an insured or an uninsured mortgage, it doesn't have to be in one of those categories.
Right.
Either one of those categories qualifies as long as you qualify under the home buyer's plan.
Yeah, excellent stuff. Okay, so. You said, ask me a question, Garrett, and then you weren't giving me the answer. So I'm excited to hear what this is because it was an odd question. So the setup, my friends, is what we're not going to pretend. Cornflakes and real estate. What the heck does cornflakes have to do with real estate, Dion?
Right. Okay. And this isn't, I guess, an anecdote or an example that I used, and I just used it this morning with a client. So it's top of mind. So I'm like, okay, well, and it's really talking about the different types of lenders that exist in the world of lending, in particular, the difference between major banks and what we call monoline lenders. And to put it in the form of a simple example, which I thought about this maybe 15 years ago, as I was trying to get my head around it. It's always like, how do I understand this, and how would I explain this to somebody so they can get it straight away? So the example is this. I want you to imagine you go to your local supermarket, you walk down the cereal aisle, and you are buying cornflakes, okay? And when you walk down the cornflakes aisle, the cereal aisle, Kellogg's cornflakes is at eye level, right? It's right there. It's in the big box. It's got the rooster on it. Everybody knows the color. And let's just say that's $10, okay? And so you're out buying cornflakes. That's the simple, easy, everybody knows cornflakes. Now, that box is $10, but below it, just below your eye line, is a yellow box that says cornflakes, but the brand on it is No Frills. And that box doesn't cost $10. It costs $9, okay? It's $1 cheaper. Now, the funny thing is, if you pick up both those boxes, put them side by side, and see where they're manufactured, you might be surprised to see they're manufactured in the same factory, okay? Now, how does this relate to mortgages? Right, so in the world of mortgages, guys, and I'll give you another example. Let's say that TD Bank takes on $1 million in deposit from their depositors who are savers. Under this thing in the world of finance called fractional reserve lending, if they've got $1 million on deposit, they can actually go and lend $10 million in mortgage financing, okay? They don't have to have 10 million to lend 10 million. That's a conversation for another day. But as it relates to this, let's say that TD can only get 7 million lent out through mortgages through their regular retail branches. So they have $3 million of extra capacity to lend money if only they could find a borrower, okay? Now, if they were to start lending that money at their retail branches at a cheaper price, yes, certainly they would get that money lent out. But they can't do that because it will dilute their brand and it will disillusion the people who borrowed money yesterday at a slightly higher interest rate. So what they'll do is they'll take that money and they'll lend it through a different lender. In our world, we call them monoline lenders. And those lenders are able to lend you TD money cheaper than TD would do it directly at their branch. And so in the world of finance, in the world of mortgages, this is the world that I'm in every day. When a client comes to me, I listen to their circumstance and I go, do you need the fancy cornflakes box? Or can I put you in the less fancy box, which does the exact same job, but is cheaper for you? And so that's why mortgages are like cornflakes. And these are the conversations I'm having with clients right now. And many of them feel more comfortable buying the cornflakes or buying the big brand name. But once they understand that there's really no significant difference between that and the monoline lender, most of them will actually be happy to move forward with that monoline lender.
And I like that analogy. The monoline lenders too will perhaps have slightly different borrowing qualifications or be able to loan that money out slightly differently, right? Is that my understanding?
So it's interesting. Some people think these other lenders fall into the B category, but they are very firmly in the A category.
Right.
And funnily enough, depending on the lender, some of their qualification requirements can be in fact more difficult than what you'll find at a bank,
Sure.
right? So again, we just need to make sure that the product meets the client's needs and they'll actually qualify. But I will tell you, and I'm sure you're the same. In my history, I have had mortgages from monoline lenders because it was the right thing at the time, and I've had mortgages with banks because again they serve a different purpose at a different time in my life. But yeah, they can be in fact equally or more difficult to qualify with.
Right. That's good. And the other interesting thing here, as we talk about different lenders and we've talked over time that perhaps lenders start offering different perks or additional ways to attract borrowers to their bank. That we're seeing that ramp up a little bit. You said to me this morning that that's coming with a slight twist now, meaning, well, you take it from there. What you meant by that?
Yeah, sure. So a perfect example. This morning I had a conversation with a client. He's up for renewal with RBC within the next month. I spoke to him a couple of weeks ago, actually, and I said, listen, we've got this November rate change. Let's see what happens after that. October rate change. Let's see what happens after that. And that's why we had set this meeting for this morning. And this morning he told me, look, Dion, RBC is offering me a renewal at 4.51%. And when I looked at my rate sheet, I saw that, okay, we could get that pretty much identical product with Scotiabank at 4.19, which would be a saving of 0.32%, 32 basis points. So pretty big saving. Now, I went on to explain to him that, as part of this, what banks are doing by offering these lower rates, they're also trying to attract new customers into their deposit base, right? Whereby, if you're going to have a mortgage, that's one thing, but it'd be nice if, from the bank's perspective, you were also depositing money into their bank account. As I said earlier, when that money comes into that bank's bank account, they can then go lend that on a multiple of 10 times. So this is the incentive for the bank to attract more customers. And I said to the client, look, one of the criteria for you to qualify for this rate will be opening a bank account with Scotiabank and having your mortgage payment come out of that bank account, right? So in my mind, that's a pretty small ask, but for this particular client, he felt like, that was a little bit tedious and onerous to do. So I acknowledged that, and I said, look, we'll do whatever's right for you, but I sat down and I ran the numbers with him. His mortgage is up over $730,000, and based on this saving, it was going to be in excess of $2,000 a year multiplied by the 3-year term. So it would have been around $6,000 in savings. So when I asked the question, hey, listen, for the trouble of setting up internet banking one time to transfer money from this account to that account on the same day every month, which will literally take him 10 minutes, would you be willing to spend 10 minutes to save $6,000 over the next 3 years? And once he saw it from that perspective, he's like, oh yeah, it's worth the trouble. We'll do that. So just don't let little things like inconvenience and paperwork hold you up. And I had a different conversation with a different client this week where I said, in life, it's those who can put up with the most amount of red tape, documentation, and BS. They're the ones who actually succeed the most in life, right? So, and our job is to make sure that we make that process as easy as possible. So, at the end of the day, he's going to take that deal.
Yeah. So just doing a little homework and looking at the bigger picture apart from, I love that, because my first thought is I don't want to go through that either.
Yep.
But I love that you kind of peel that onion away and like literally takes 10 minutes to save $6,000. Yeah. Sign me up.
That was it. Yeah. So a bit of a no-brainer at that point.
Yeah. And we're seeing that more and more, right, Dion? I remember seeing that even 7-10 years ago. Yeah, we're going to give you this credit card, or we're going to give you this bank account, or this high interest savings account, because as you said, they want money and deposit money coming in, which they can leverage, right?
You got it. Yep. And so, look, life is give and take, and we're all part of a bigger economic system. You got to understand the game, and you got to sometimes play the game, but make sure that you're the one winning in the game, not just being taken advantage of, right?
Yeah. And knowledge is key, my friends. We always know that. Okay. So as we wrap up today, there's a few things here that are incredibly important. From a market, where the market stands right now, September, October, Dion, was we're not used to the slowness, right? From the big picture, meaning the number of transactions, and if you read the headlines, condo or new construction sales are way down, and transactions are just kind of plateaued at they've kind of hit a valley, right? And they're sitting there. And my friends, my advice to you over the next couple of months is, it'll feel like it's starting to get busy just because the number of sales have just ticked up a little bit. So it'll feel like the market's coming at us fast. So the big picture is it still isn't, because we are in the Toronto area. We'll probably see less sales than we had last year, which was about 64,000 sales of resale homes.
Oh, okay. You mean by the end of this year?
Yeah, by the end of this year, that's right. And a good moving market, as we've always said, is about 90,000. So we're a far cry away from that. So we've got lots of room. However, moving into next year, I don't know if we reach 90,000 sales next year, but it'll feel like we're busy because anything above the 60,000 mark where we are today will feel like we're busy. So always know what it is that type of market we're getting into, and there's always cycles in the market. And I really feel right now, that the whole Game of Thrones analogy, winter is coming. It came, and we're in it, and I believe spring is around the corner.
Yes, and you know what? I want to make a public service announcement, if I could, Gary, to all the Canadian banks and lenders out there, which is, if you haven't figured it out yet, you're going to be busier next year than you are this year. Okay. And what I will tell you, Gary, is whenever I've been through these market cycles up and down, and I've been in this business now 20 years, banks are always very slow to hire.
Yeah.
And what that means is it's like all of a sudden they're like, oh, wow, where did all these deals come from? I'm telling every lender and banker who's listening right now, please go hire some people now, because come the new year, you're going to be busy. And I don't want to be the guy having to explain to my client why their file's taking longer than normal because you guys didn't fire up your HR departments in November 2024. Okay.
I love it.
All right. I know it's going to happen. It's going to be a pain. It always is.
Yeah. Yeah. Good stuff, my friends. Always good to have you on the call, Dion. Remind us how to get a hold of you.
Yeah, at kangamortgage.ca or Instagram at the Dion Beg.
There you have it. So that's Dion Beg. I'm Gary McGowan. We'll see everybody in the next call. Bye for now.